Hello, beautiful people, and welcome back to Boni's Life, and a highly deserved welcome to my new subscribers from Nelson Mandela Metro in Eastern Cape, South Africa, where I'm enjoying my vacation. I'm your host, Boni, and this week we're diving headfirst into the digital gold rush with what might be one of the most critical weeks of the year. We'll be dissecting the past week's market madness, gazing into our crystal ball for the week ahead, and most importantly, arming you with the strategies to navigate these choppy waters like a seasoned captain. So, grab your coffee or something stronger if it's been that kind of week, and let's get into it. Alright, let's start with a look back at the week that was. The crypto market has been a bit like a moody teenager lately, showing flashes of brilliance followed by moments of sullen silence. Bitcoin, our glorious leader, has been flirting with the $90,000 mark, but seems to be getting a little shy, currently trading around $88,143. That's a respectable 2.3% gain over the last 7 days, but the struggle to decisively break that psychological barrier is palpable. We've seen a bit of a consolidation pattern, with Bitcoin bouncing between $85,000 and $90,000. Think of it as the market taking a deep breath before its next big move. The Fear and Greed Index is currently flashing a score of 21, which is firmly in fear territory. Now, for the contrarians among us, that can be a beautiful sight. As the old saying goes, be fearful when others are greedy, and greedy when others are fearful. But for the rest of us, it's a sign to tread carefully. This level of fear hasn't been seen since the market correction back in August, and historically, these extreme fear readings have often preceded significant bounces. However, they can also signal that more pain is ahead before the relief rally arrives. Looking at the charts, we have some key levels to watch. On the downside, we have initial support around the $86,000 mark, with a more significant floor at $85,000. If we see a break below that, things could get a little chilly, with some analysts pointing to the $78,500 level as a potential target. That would represent about a 10% drop from current levels, which in crypto terms is just another Tuesday. On the upside, if we can finally conquer $90,000, the next targets to watch are around $91,500 and then $93,700. Breaking through these resistance levels would likely trigger a wave of short liquidations and FOMO buying. Our trusty technical indicators, the RSI and MACD, are giving us mixed signals. The RSI is hovering around the neutral 50 mark, suggesting a balance between buyers and sellers. This is actually a healthy sign after the recent volatility we've experienced. The MACD, however, is still in bearish territory, though it's showing signs of a potential bullish crossover. It's like the market is whispering, I want to go up, but I'm just not sure I have the energy. The histogram is starting to compress, which often precedes a significant move in either direction. Now, let's not forget about the queen of crypto, Ethereum. ETH has actually outperformed Bitcoin this week, with a solid 4.4% gain, and is currently trading around $2,980. It's been in a tight consolidation range between $2,790 and $3,000. That $2,930 level is absolutely critical, and I cannot stress this enough. If we see a decisive close below that, some analysts are warning of a potential slide down to the $2,000 region. That would be a catastrophic 33% drop and would likely drag the entire altcoin market down with it. However, the daily stochastic indicator is in oversold territory, which could suggest a bounce is on the horizon. We've also got the 200-day moving average sitting right around the $2,850 mark, providing additional support. If we can break above the $3,000 resistance, the next target is around the $3,200 mark. It's a real nail-biter for ETH holders right now. The Ethereum ecosystem has been under pressure lately, with concerns about Layer 2 solutions cannibalizing mainnet activity and competition from Solana and other smart contract platforms. But fundamentally, Ethereum remains the backbone of DeFi, NFTs, and the broader crypto ecosystem. Let's talk about what's happening in the derivatives market, because this is where the real action is. The total open interest across all crypto derivatives is sitting at 127 $0.88 billion, down about 1.5% from last week. Bitcoin's share of that is $57.88 billion, while Ethereum accounts for $37.44 billion. What's really interesting is that options open interest has surged by nearly 44% to $62.17 billion. This is massive, folks. It suggests that traders are positioning for significant volatility ahead. The funding rates across major exchanges are mostly neutral to slightly positive. Binance BTC USDT Perpetual is showing a funding rate of 0.0089%, which is pretty much neutral. When funding rates are this low, it means there's no extreme bias in either direction. The long-short ratio is currently 48.27% long versus 51.73% short, showing a slight bearish bias among retail traders. However, when we look at top trader positions, they are actually leaning long with a ratio of 2.27 to 1. This divergence between retail and professional traders is something to note. Liquidations over the past 24 hours totaled $66.55 million, which is actually down 66% from the previous day. This suggests that the market is becoming less leveraged, which is generally a healthy sign. When leverage is too high, it creates a powder keg situation where a small move in either direction can trigger cascading liquidations. Now, let's zoom out from the charts and look at the bigger picture. The crypto market doesn't exist in a vacuum, and there are some powerful fundamental forces at play. The big news of the past week was the Federal Reserve's decision to cut interest rates by another 25 basis points, bringing the federal funds rate to a range of 3.5% to 3.75%. This is the third rate cut in a row, which is generally good news for risk assets like crypto. Lower interest rates make holding cash less attractive and can push investors towards higher-yielding assets. However, and this is a big however, the Fed's commentary was a bit more hawkish than some had hoped. Chairman Powell signaled that they may slow down the pace of rate cut in 2026, citing persistent inflation concerns and a resilient labor market. This has put a bit of a damper on the party, and we've seen the US dollar index tick up slightly to $98.25, which can be a headwind for Bitcoin. Historically, Bitcoin has an inverse correlation with the dollar. When the dollar strengthens, Bitcoin tends to weaken, and vice versa. The bond market is also sending some interesting signals. The 10-year Treasury yield has climbed to a 3-month high, suggesting that investors are demanding higher returns for holding government debt. This is typically a sign of inflation expectations rising or concerns about the fiscal situation. For crypto, rising yields can be a double-edged sword. On one hand, they make traditional fixed income investments more attractive. On the other hand, they can signal economic uncertainty, which sometimes drives investors toward alternative assets like Bitcoin. Another key factor to consider is the upcoming holiday season. We're heading into the last week of the year, and that typically means lower trading volumes as institutional traders head off for some well-deserved rest. Last year, during the Christmas week, we saw Bitcoin trading volumes drop by nearly 40% compared to normal levels. This can lead to increased volatility, as smaller trades can have a bigger impact on the market. It's like trying to turn a speedboat versus an aircraft carrier. The lighter the boat, the easier it is to change direction. We're also seeing some year-end portfolio rebalancing and tax loss harvesting. Institutional investors and funds often rebalance their portfolios at year-end to maintain their target allocations. If crypto has outperformed other assets in their portfolio, they might sell some to bring it back in line. Tax loss harvesting is when investors sell losing positions to offset capital gains for tax purposes. This can create additional selling pressure in the short term. And let's not forget about the Bitcoin ETFs. After a period of strong inflows that helped drive Bitcoin to new highs earlier this year, we've seen a trend of net outflows in recent weeks. On December 19th alone, we saw outflows of 1,850 BTC. December 18th saw outflows of 1,870 BTC. However, December 17th saw inflows of 5,210 BTC, showing that the flows are quite volatile. This suggests that some of the early institutional investors are taking profits, which is a natural part of the market cycle. The total Bitcoin held in spot ETFs is still substantial, representing a significant portion of the available supply. So, what does the week ahead have in store for us? Well, it's a relatively quiet week on the economic calendar with the Christmas holiday on Thursday. But in the crypto world, there's always something happening. On December 22nd, we have a significant token unlock for MBG by Multibank Group. They are unlocking 15.84 million tokens, which represents about 8.42% of the circulating supply. Token unlocks can sometimes put downward pressure on prices as more supply hits the market, especially if early investors or team members decide to sell. We also have several governance votes happening. Axie Infinity is voting on whether the Treasury should stake its AXS and RON tokens. Moonwell has an on-chain vote about updating Oracle configurations. These might seem like minor technical details, but they can have significant implications for token holders and the broader ecosystem. Governance participation is actually a great way to stay engaged with your investments and understand what's happening under the hood. And here's the big one. We'll be watching the Bitcoin options expiry next Friday with a whopping $23 billion worth of contracts set to expire. This is absolutely massive. To put that in perspective, that's nearly 2% of Bitcoin's entire market cap in options contracts. When options expire, it can create significant volatility as market makers unwind their hedges and traders close or roll their positions. The max pain point, the price where the most options expire worthless, is currently around $87,000, which is very close to where we're trading now. It's always good to get a second opinion, so let's see what some of the big players in the space are saying. Citigroup recently came out with a very bullish base case for Bitcoin, targeting $143,000 within the next 12 months. That represents a 62% gain from current levels. Their analysts Alex Saunders, Dirk Willer, and Vin Vo are pointing to revived ETF demand and a positive outlook for the stock market as key drivers. They also mentioned the potential passage of the Clarity Act, which would provide much-needed regulatory clarity for the crypto industry. Their bear case is $78,500, which would occur in a global recession scenario. Their bull case is an eye-popping $189,000, driven by massive end investor demand. On the other hand, some analysts are more cautious. ChatGPT's AI model, when asked to predict Bitcoin's year-end price, came up with a range of $85,000 to $86,000. That represents about a 3.9% drop from current levels. The AI cited macroeconomic headwinds, regulatory uncertainty, and profit-taking as key factors. While AI predictions should be taken with a grain of salt, they do provide an interesting data-driven perspective. Grayscale, one of the largest crypto asset managers, released their 2026 outlook titled Dawn of the Institutional Era. They are suggesting that we're just at the beginning of a major wave of institutional adoption. The US has made significant strides toward crypto regulatory clarity in 2025, and they believe this will unlock a flood of institutional capital in 2026. They're particularly bullish on Bitcoin and Ethereum, but also see opportunities in DeFi, tokenization, and blockchain infrastructure. The team at Bitwise, another major crypto asset manager, has made some bold predictions for 2026. They believe Bitcoin will break its traditional 4-year cycle and set new all-time highs. They also predict that Bitcoin will be less volatile than Nvidia stock, which is a fascinating comparison. If true, it would represent a major maturation of the Bitcoin market. They're also bullish on ETF flows continuing to drive institutional adoption. Tom Lee from Fundstrat, one of the most well-known Bitcoin bulls on Wall Street, has been talking about different time horizons. His short-term tactical view is more cautious, acknowledging the current consolidation and potential for a pullback. However, his long-term strategic view remains very bullish, with targets well above $100,000. This highlights the importance of distinguishing between short-term trading and long-term investing. All right, this is the moment you've all been waiting for. How do we trade this market? Given the current uncertainty and the upcoming holiday period, a cautious approach is probably the most sensible one. Let me break down strategies for different types of traders. For short-term traders and day traders, range-bound strategies could be effective. Look to buy near support and sell near resistance, but be sure to use tight stop losses. For Bitcoin, that means watching the $85,000 to $90,000 range. If we're trading in the middle of that range, you might want to wait for a move toward one of the boundaries before entering. If Bitcoin breaks above $90,000 with strong volume, that could be a momentum trade to the upside, targeting $91,500 and then $93,700. If it breaks below $85,000, you might consider a short position targeting $82,000 or even $78,500, but be very careful with shorts in a generally bullish market. For Ethereum, the range is $2,800 to $3,200. That $2,930 level is your line in the sand. If ETH is trading above it, you can be cautiously bullish. If it breaks below with volume, that's a major warning sign. A break above $3,200 could open the door to $3,500 and beyond. The ETH-BTC ratio is also worth watching. If Ethereum is outperforming Bitcoin, it often signals that altcoins are in favor. For swing traders looking at a multi-day to multi-week time frame, this could be a good opportunity to dollar cost average into your favorite projects. The fear in the market could present some attractive entry points. Consider splitting your capital into multiple tranches and buying on dips. For example, you might buy 25% of your intended position at current levels, another 25% if Bitcoin drops to $85,000, another 25% at $82,000, and keep the final 25% for a potential drop to $78,500. This way, you're not trying to time the exact bottom, but you're getting a good average entry price. For long-term investors and hodlers, this is noise. If you believe in the long-term thesis for Bitcoin and crypto, decentralization, sound money, financial inclusion, programmable money, then these short-term fluctuations are just opportunities to accumulate more. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." With the fear and greed index at 21, we're definitely in fearful territory. Let me talk about risk management, because this is what separates successful traders from those who get wrecked. First, never invest more than you can afford to lose. This is especially true in crypto, which is one of the most volatile asset classes in the world. A good rule of thumb is that your crypto allocation should be no more than 5 to 10% of your total investment portfolio, depending on your risk tolerance. Second, use stop losses. I know it's painful to get stopped out and then watch the price reverse, but stop losses are your insurance policy against catastrophic losses. For swing trades, consider using a stop loss of 5 to 7% below your entry price. For longer-term positions, you might use a wider stop of 15 to 20%, or even a mental stop where you reassess your thesis if the price drops that much. Third, take profits along the way. One of the biggest mistakes I see is people riding their winners all the way up and then all the way back down. Consider taking out your initial investment once you've doubled your money, and then let the rest ride. Or use a trailing stop loss that moves up as the price increases. Fourth, diversify. Don't put all your eggs in one basket. Even within crypto, consider holding a mix of Bitcoin, Ethereum, and select altcoins. Bitcoin is your digital gold. Ethereum is your exposure to smart contracts and DeFi. And altcoins are your high-risk, high-reward bets. Here are a few key triggers to watch for in the next 24 to 48 hours. A decisive break above $90,000 for Bitcoin would be a very bullish signal and could open the door to a Santa Claus rally. We'd want to see this break happen on strong volume, at least 20 to 30% above average. If it happens on light volume, it's more likely to be a false breakout. On the flip side, a break below $85,000 would be a bearish signal and could lead to a further correction toward $82,000 or $78,500. Again, volume is key. If we see a high volume breakdown, it's more significant than a low volume drift lower. For Ethereum, a close below $2,930 would be a major red flag. I'm talking about a daily candle close, not just an intraday wick. If we see that, it could trigger a cascade of stop losses and potentially lead to that $2,000 target that some analysts have mentioned. On the other hand, a break above $3,200 would be a strong sign of a bullish reversal and could lead to a catch-up rally relative to Bitcoin. Watch the Bitcoin dominance metric. It's currently at 58.95%. If it starts rising, it means Bitcoin is outperforming altcoins, which often happens in uncertain markets as traders flee to safety. If dominance starts falling, it could signal the start of an altcoin season. Keep an eye on the funding rates. If they turn significantly negative, it means shorts are paying longs, which often precedes a short squeeze. If they turn significantly positive, it means longs are paying shorts, which can indicate an over-leveraged long position that's vulnerable to a correction. Let's zoom out even further and think about where we are in the broader crypto market cycle. Bitcoin has historically followed a 4-year cycle, driven largely by the halving events that occur every 4 years. The most recent halving was in April 2024. Historically, Bitcoin tends to bottom about a year before the halving, rally into and through the halving, and then see its biggest gains in the 12 to 18 months after the halving. If history repeats, we should be in the early to middle stages of a bull market. However, some analysts, including Bitwise, believe that this cycle might be different due to institutional adoption through ETFs and increasing mainstream acceptance. The traditional 4-year cycle might be breaking down. On-chain metrics provide some interesting insights. The number of Bitcoin addresses holding at least one Bitcoin has been steadily increasing, suggesting accumulation by retail investors. Whale addresses holding more than 1,000 BTC have also been accumulating. Exchange balances have been declining, which is typically bullish, as it suggests people are moving their coins to cold storage for long-term holding, rather than keeping them on exchanges to sell. The Bitcoin network hash rate is at all-time highs, indicating that miners are confident in the future of the network and are investing in more equipment. Miner selling pressure has been relatively low, suggesting they're holding rather than immediately selling their newly mined coins. So, what's my personal take on all of this? I think we're in a consolidation phase that could last through the holidays and into early January. Bitcoin will likely continue to trade in the $85,000 to $95,000 range. The $90,000 level is proving to be tough resistance, but I don't think it's insurmountable. Once we get past the holidays and institutional traders return to their desks in January, I expect we'll see a push higher. The $23 billion options expiry next Friday could create some fireworks, so be prepared for volatility. If I had to put a number on it, I'd say there's a 60% chance we're higher by year end, a 30% chance we're roughly flat, and a 10% chance we're significantly lower. Those aren't scientific probabilities, just my gut feeling based on the data we have. For Ethereum, I'm cautiously optimistic. That $2,930 support level is critical, and as long as it holds, I think ETH can work its way back toward $3,500 in Q1 2026. The Ethereum ecosystem is incredibly robust, and despite competition from other chains, it remains the dominant platform for DeFi and NFTs. Looking further out to 2026, I'm bullish. I think Citigroup's $143,000 target is achievable, though it might take longer than 12 months. The institutional adoption story is real, regulatory clarity is improving, and the macroeconomic environment should become more favorable as the Fed continues to cut rates. And that's a wrap for this week's episode of Boni's Life. I hope you found this analysis helpful and actionable. Remember, the crypto market is a wild and wonderful place, but it's also a risky one. So, trade smart, stay informed, and don't forget to take some profits along the way. Don't let greed turn a winning trade into a losing one. If you enjoyed this video, be sure to hit that like button. It really helps the algorithm show this content to more people. Subscribe to the channel if you haven't already, and ring that notification bell so you never miss an update. We put out weekly market analysis every week, and I'd hate for you to miss out. And as always, I'd love to hear your thoughts in the comments below. What are your predictions for the week ahead? Are you bullish or bearish? What's your target for Bitcoin by year end? Do you think Ethereum can hold that $2,930 support? Let's get a discussion going in the comments. I try to read and respond to as many comments as I can. If you want to dive deeper into crypto trading and analysis, check out the links in the description. And remember, this is not financial advice. I'm just a guy who loves crypto and wants to share my analysis with you. Always do your own research, never invest more than you can afford to lose, and consider consulting with a financial advisor before making any investment decisions. Until next time, stay safe, keep learning, and stay disciplined. This is Boni signing off. See you in the next one.